Thanks, David, and good afternoon, everyone. It's great to be here, and my job's really easy today because I've got a fantastic panel to introduce you to. To my nearest is Lisa Jacob, who's the head of strategy at Funding Circle. We've got David Goldin, who's the founder and CEO of Capify, who you would have heard of, and also Jeff McCarthy, who's to the furthest away from me, who's the co-founder and CEO of Kikka Capital. So we've got a great international panel. Strategic partnerships is the topic of what we're going to talk about, and it's really hard. I was reading a Forbes magazine article that suggests that business partnerships are harder than marriage, and effectively the divorce rate of business partnerships is around 80%. So it's really hard to get right, easy to get into, hard to make work, and probably pretty messy to get out of. The panel today is going to share some really interesting stories. My job's to talk less and actually provide a platform for them. I really enjoyed speaking with each of them individually to hear about their individual stories. So I'm going to start off with David, if I can. David, can you tell us a little bit about the story of Capify, and in doing so also share a little bit about the Alibaba partnership, which we've heard a lot about. So over to you.
Sure, thank you, and thank you for having myself today. So give everyone a brief background. My name is David Goldin. I'm the founder, president, CEO of a company called Capify. We were actually one of the first alternative lenders for small businesses in the world. We started the company in the United States back in 2002, before the word alternative finance even existed. During the time right before the global financial crisis, saw the foresight of some of the trends that we didn't like in the marketplace and decided to take the business model, the technology, and the platform up to Canada in 2007. And in 2008, moved it also over to the United Kingdom, and in 2008 also in Australia as well. As far as we know, we are the first alternative lender for SMEs in Australia. The first to also bring in the daily repayment mechanism, both on a fixed basis and a percentage basis, which a lot of our customers like based on their sales. And we have approximately 45 employees here in Australia. And as Ian mentioned before, the company has about 220 plus employees globally, headquartered in New York City, with offices in the UK, Canada, and of course Australia. We've primarily been a balance sheet lender up until recently, where we're haven't officially announced it, but what better place. But we're also now opened up our marketplace as well to institutional investors looking to buy our loans in each of the different countries. As far as I know, we're the only company in the world operating this longevity in the United States, UK, Australia, and Canada, and more importantly, have the underwriting diligence and data to back it up. To Ian's point, our company also has entered into a lot of different strategic partnerships through the years. In the UK, partnered with PayPal for some time. The United States with a company called Vantiv, one of the largest merchant processors there, publicly traded, part of Fifth Third Bank, with 400,000 customers. And of course, here in Australia, with Alibaba, we entered into a partnership to provide that, and we can talk further about that as well, where we're providing access to capital for Australian businesses looking to buy on the Alibaba platform. And essentially, we had operated under different names up until last year. We originally started as a Merrill Merchant in the US, United Capital in the UK, True North Capital in Canada. Of course, we were called Ausvance in Australia, and decided last year to rebrand as one global company called Capify. One of the things that we were finding out is that people didn't know we were global and international, and that was by design, to be candid, to not alert all our competitors in the US. And we were losing out on global opportunities where people didn't realize that we are one company that can actually operate in all these different markets.
Lisa, turning to you, I guess just sharing Funding Circle, we've all heard of Funding Circle, a little bit about the growth strategy. I know that you've embarked on quite a divergent strategy in the context of international expansion, from acquisition of marketplace lenders as well as partnership with banks. But perhaps I can get you to introduce Funding Circle in the context of that international expansion.
Sure. So Funding Circle is the leading global small business marketplace for lending to small business loans. We actually started in the UK. We started in 2010, and really the concept was very simple. It's something that Noah spoke about a lot earlier on today. Actually, small business lending is tough, and there's a lot of small businesses across the globe that are actually underserved. So our simple hypothesis was we can make this better, and we can make small business lending better by connecting them directly with investors who are keen to lend to small businesses. So we launched in the UK in 2008, and then we now operate in 5 geographies. So we entered the US by acquisition. And then into Europe as well, into continental Europe. Last year, we entered Germany, Spain, and the Netherlands by acquisition as well. So I think we'll talk a little bit more about that later. We've now lent over $2 billion US globally. There's about $135 million lent through the platform on a monthly basis across all the different geographies. And it's funded directly, so we're not a balance sheet lender. It's funded directly through the marketplace from 50,000 retail and accredited investors, institutional investors, and public bodies.
Thanks very much, Lisa. Jeff, handing over to you now, just in terms of Kikka Capital. Clearly, it's quite notable, the licensing arrangement with Cabbage, so perhaps a bit about Kikka and that arrangement.
Yeah, great. Thanks very much for having me, and tough acts to follow here, but hopefully I can shed some slightly different perspective given we're a relatively new entrant to the marketplace. But as you alluded to, Kikka has partnered with Cabbage, which, as many of you may know, is been around for quite some time and raised significant venture funding and put out well over $1 billion over several 100,000 loans, both in the US and the UK. So in brief, just backing up a step, I spent several years of my career building the institutional investor function at Lending Club, left several years ago and partnered up with some guys out of Perth who have for the last several years been running a short duration, cash flow assessed, very technology heavy consumer lending product. And shortly after joining the board and seeing what the guys had developed and some of their vision for the business, we decided to look to build a similarly competitive product, if you will, focused on the small business lending opportunity. And it was a build versus buy decision. So clearly some benefits that we can get into later around why we chose to go about entering the market via a partnership versus building our own technology. We'll again back into, I'm sure, throughout the panel, but we had made the decision and happily have partnered with Cabbage to essentially license their credit engine and risk scoring engine and launch under our own brand and equity capital under the Kikka banner, and have launched just in the past 6 months in the Australian market. So we're quite excited about being in the space, being in the game, and seeing some very positive data points coming through the system already here in the first few months of operation.
Thanks very much. So David, just to you, I guess you mentioned the expansion into 4 markets, 14 years under your belt. I guess just wanted to turn to you. What are the critical success factors? I opened with at the onset around how hard it is to make partnerships work. What would be your advice to platforms in the audience, as well as larger institutions that are seeking to form relationships with platform providers?
Sure. So I think one of the most important things that we learned by doing this is when you're looking to expand to other markets, it's very important to also have a local presence there. There are certain companies, especially in the US, that have tried to go into other markets, running them out of the US or running third-party sales groups. And there's a huge difference both on the marketing side from a cultural perspective, and really the underwriting is different in almost every single market. I mean, I say this all the time. Anyone can originate. Anyone can fund deals. The real talent is collecting it back. And I think we're going to learn more and more how true of a statement that is based on, where as interest rates go up and the credit markets get tighter and defaults go up, while technology is great and sales and marketing is great, and you're already starting to see the trends where publications used to write about how much can you fund, and now the articles are starting to come back with, what's the default rates? They're coming in higher than expected, and I think you're going to see a change in investor behavior. So to really answer the question, most importantly, is not when you enter into a new market, be cautious. Don't get caught up in the hype of crazy originations out of the gate, because you will get hurt. It's impossible not to. So you really have to be focused and understanding, especially if you're already in the business in a different market, the underwriting and the performance of the portfolio. The only way to get the data is to be in that market for quite some time to understand how it's going to perform.
Great. I might ask Lisa and maybe Jeff to follow. We spoke about build, buy, partner. Clearly, you've adopted a few different options in terms of that international expansion you covered earlier on. What's driven that? How do you sort of assess what the right approach is for a given market?
I think building on what David said, actually a local team on the ground is really important. It brings that credibility, it brings the understanding of the marketing, it brings the understanding of the credit as well. And actually being able to back that up by having the global technology architecture, by actually having a global risk and analytics team, because whilst you have to make those learnings in new geographies, there is quite a lot of crossover in the analytics approach and in what we can share between geographies. So that for us is the reason why we've chosen in the markets we've entered to enter through acquisition. And it's slightly different to a partnership, but I think the same ingredients hold. And we can see that actually in the Australian market, if you think about a lot of the entrants, I'd say about half of the platforms now seem to be the partnership platform, really focused on bringing the expertise and the scale that Noah spoke about and combining that with local teams here in Australia. So I think that's a key importance of expanding into new markets. Obviously, you want the right partner, so in markets where that right partner doesn't exist, then I think there's a very strong case to actually being able to build that yourselves.
Just in the context of funding circles relationships, we've spoken about RBS and Santander. How does that peacefully coexist in terms of having relationships with a few different incumbent organisations in a market?
Yeah, and I think this is something that's come up throughout the day. Actually, bank partnerships are great because in Funding Circle in the UK, we have a relationship with RBS, with Santander. We also work with a number of the other banks on a referral basis. In the US, we have relationships with banks where we're actually talking about doing a fuller service offering, and that's due to the different dynamics of the market. There's much smaller banks. And in terms of allowing us to grow, there's a couple of things which it enables us. The first is credibility, and I think a lot of the players in the room and a lot of the players across the industry, we started off smaller, and actually being able to have a partnership with a well-known brand brings that credibility to the marketplace, which is very important in the early days. And the other thing is, one of the UK market is very consolidated. We have 4 major banks, and as one of the chief risk officers explained to me, ideally they would like the businesses to come to them to be that perfect bell curve in terms of the riskiness of those businesses. What they actually get coming in the door is pretty different from that. And so whilst a lot of those businesses, they would be keen to serve and maybe do 10% of the loan, they don't want to have to do the entirety of that loan because they're trying to balance their portfolio of risk, and that goes by risk and also by segment, by geography. But that bank doesn't want to lose that customer. And this was alluded to in the Morgan Stanley presentation earlier. There's a very profitable back book. There are customers who have multiple products with that bank. And for us as Funding Circle, the great thing we can do is actually say to the bank, well, you can keep the customer. We're not trying to grab the current account. We're not trying to grab the insurance and all the other products that you want to sell to that customer. But what we can offer is that loan that you don't really want to do. So the customer won't go away. And the other thing that the banks really care about is the customer satisfaction rate. You saw Noah talk about how high that is for OnDeck. We have similarly high rates. It's about 80, 90% across the US, UK. And you can compare that to banks where it's negative in the UK and in the low teens in the US. So actually, this is really supporting banks with their aims of being able to drive customer satisfaction, keep customers, and actually gain new customers, because in some instances, they're able to say, we can lend to you through this partnership that we have, which means that the customer will come and join that bank and bring the rest of their relationship to that bank.
Thank you. Jeff, just back to you now in terms of the critical success factors. Clearly you bring some experience of having worked at Lending Club in the US. What's your view around those really important facets that need to be understood and well aligned with the partner?
Yeah, thanks. Try not to be redundant here, but some great points have been made. But in brief, our ambitions in launching Kikka via partnership were really obviously combining what the team in Perth had built and developed for 2 years, really on local knowledge, regulatory workings, customer origination, customer servicing, and collections, and a lot of that. Again, had been done via some boots on the ground and some real in the trenches experience and a lot of technological iterations to build a very lean, efficient system that can do that incredibly cost effectively. our ambition was to get to market quickly, and then partnering with Cabbage obviously allowed us to take a proven credit engine through, of course, 7+ years of their experience in refining that model and bringing that via our local experience, knowledge, and regulatory and technological workings here in Australia. So clearly the benefits of speed to market, of credibility, and of obviously bringing together strategic equity and debt capital to get the business operational really were benefits to pushing towards a partnership type structure.
And what's your view of the Australian market vis-a-vis, I guess, what you've observed over the last sort of, say, 9 to 10 years in the US? How do you place the Australian market vis-a-vis, I guess, a number of other markets that are either developed or developing in terms of alternative finance?
Yeah, well, I think it's clear that there are some there's a framework here via the incumbent banking system that clearly seems to mirror quite closely to the UK and the US, such that there's just terrific pockets of underserved and unserved populations on both consumer and the small business side. So there's lots of subsets of that, obviously, the different players and participants, I'm sure, here at the conference are focused on addressing. In our instance, we've really taken a liking to short duration credit products for a whole host of reasons, and I'm quite excited about the ability to get out in front, if you will, and lock up strategic partnerships to distribute our products in that market. But to your broader question, I certainly am not a resident expert on the Australian economy, but they're due to commodity-based headwinds, if you will, and what's happening in China and the like, a lot of the U.S. mentality naturally has some questions or some hesitancy, if you will, if you're looking at being a venture capitalist or an equity sponsor in an Australian-focused unsecured lending capacity. So I think there's some questions that need to be addressed there about how you're obviously what niche you're focused on, how you're engaged in your underwriting model, and obviously whether you're doing asset-backed lending or unsecured lending, et cetera. So there's some perhaps more potentially embedded volatility to an Australian economy at a high level that requires some additional convincing. But if you can get capital to work at this point in the cycle, I think you're teed up for a nice return on investment. I think there's just going to be terrific opportunities for a lot of people here to position themselves in clearly what is a ripe future for alternative finance here in Australia.
Lisa, I wanted to draw you in on, I guess, the government, the role of government, and I'll invite the other panellists to offer their views as well. I mean, I know we spoke about the British Business Bank, the role it played, not so much from a funding perspective, albeit that was important, but in the context of actually raising awareness. And I know that was covered by the previous panel, but your perspectives, given that the Australian government last week announced a task force, in the context of that, what role has the British Business Bank played in terms of developing alternative finance there?
I think, David made the point earlier that alternative finance is now becoming mainstream. One of the things that I think has been very important for us in driving that in the UK is the regulator in actually regulating the industry, but also the government in being very supportive of this. What I see across different markets is that the government really sees small businesses as being a driver of economic success, and they're looking for ways to support small businesses access finance. So in the UK, we formed a partnership with the British Business Bank, who are a government-owned bank, to encourage lending to small businesses. And they actually lend through the platform directly to small businesses. So there's 60 million committed. There are about 50 million through that already. I think what was important about this is it's not just the lending capital, which was helpful to us in being able to bridge the gap between smaller retail investors and actually larger institutional investors coming on the platform, but also the huge boost from an awareness point of view. And this was one of the key criteria of the program, was to try and raise awareness amongst small businesses of how else they could access finance apart from going through the banks, which is approximately 85% of lending in the UK. So that has been very helpful for us, not only on awareness front, but also from a credibility point of view.
David, your perspective around regulators and government and the role they need to play enabling alternative finance to grow?
Sure. So we've seen regulation, obviously, in the different markets that we operate in, and it's the irony is, in the UK world, there was a lot of noise and regulation talk about a year ago, where the US was kind of quiet. Now it's sort of the reverse, where the UK sort of mapped itself out, and now there's a lot of talk in the UK as far as what direction there's going to take. But I think what people are going to realize is that real companies encourage regulation. It's those that are, what I'll say is pushing the envelope or maybe not necessarily being upfront with the customers that are usually concerned about regulation. And the point was made before in one of the other panels about awareness. And looking around the room here reminds me, which Noah also mentioned before, back in the US, back in '07, where there's a nice size attendance here, but when you look now back in when you look forward in a few years from now, I think people are going to laugh how small this room may look if Australia grows anywhere near the rate intended to be. And what that really means is a lot of the people in this room are tied to the capital side. There's very few people I've met so far that are tied to the marketing side. And right now, there's a surplus of capital compared to qualified borrowers or borrowers out there that know about these platforms. It's a question of how do you get to them. And unless you're going to blow through $100 million, things like government regulation and providing programs that banks have referral declines, pushing out to platforms declines is only going to help the origination and the brand awareness issue. Because what we found when we entered into each of the different markets, and obviously works well for our competitors, is when we first entered Australia 7+ years ago, it was an education process. Now today, it's gotten better. It's nowhere near the other markets, but I think you need regulation, one, to make sure the businesses are protected. I can't really speak much to consumer regulation, but it's also really creating awareness is that the reputable companies should leverage government regulation to get the word out there, because that is the cheapest form of promotion and advertising.
I might just close now with a question to each of the panelists. I'll start with you, Jeff. Perhaps a more optimistic view of the future and how it's going to develop in Australia, and then secondly, a more bearish scenario and what platform providers and partnerships will need to consider moving forward. So maybe the bullish and then the bearish case.
Sure. Well, I guess I'll follow on from what David said, because I would tend to agree, and I'm enthused to see a room this size already here. But I would speculate that on the optimistic viewpoint that within a couple of years this will be a fraction of what we'll see in terms of just participants in the entire alternative lending movement. So clearly very optimistic about the opportunities in Australia across the board. And expect that we'll see lots of innovation, lots of partnerships, lots of groups vying for market share, and lots of activity here. A lot of capital obviously already is coming from offshore to find the best way to speak to and connect with Australian consumers and small businesses. So. The pessimistic viewpoint, boy, I hate to end on a sour note. So that's frankly a difficult one. I don't have a negative comment at the moment.
Sure. So similar to what Jeff said, very enthusiastic, especially seeing, we've been in Australia again, like I said, for 7+ years, and never really saw this much enthusiasm and encouragement for this market. I view the pessimism as an opportunity for the established players. You're going to have people coming in with no experience. They're going to be originating. I can't say it again. While just like our company, we have a 60-second decision platform with technology, this entire business, if you take out the word alternative, it's lending. And lending, if you do not have good underwriting and you do not know what you're doing, you will not be around for long. So I think some of the opportunity and the pessimism, where if there is a down economy, most of the fintech players around the world have not experienced a down economy. We have. It's not pretty. But those that know how to survive it, there's going to be opportunity to pick off some of these platforms, and other investors are going to try and figure out ways to get some of their capital back when defaults start going up to non-acceptable levels. So I think it's not a question of if, but when. You can't have something going up forever. So while there may be some downside, I think the stronger players, the more established players, may actually be able to benefit even further with a shakeout within the platforms, whether it's in Australia or any other markets in the world.
And Lisa, just to conclude.
Yeah, I think most of it's been said, but really exciting time now. We're becoming mainstream. There's a lot of energy here, and I think these platforms can grow regardless actually of the cycle. I just think it's a more efficient way of lending and can work in collaboration with the existing incumbents. I think on the bearish scenario, it's been said, but it's actually the watch out for platforms will fail. There will be less capital available for smaller platforms. I think there will still be capital available for the larger platforms. And I do agree with David that there is going to be a bit of a shakeout. And it's our responsibility to actually do it right and to be lending appropriately to businesses, to consumers.
Thank you. David?
Ian, thank you very much. One quick question to all of you. Now, I didn't have the good fortune to go to business school, but I'm sure there was a class in business school which said that there's this kind of rule of 3, 4, 5 businesses dominating industry. 4 banks, 5 banks. That's a pretty standard model. A lot of industries, you have that concentration. We're already seeing it in the UK. The top 3 platforms in the UK are increasing market share. Isn't the truth of this industry going to be that everybody's going to try and scale like crazy, but there is only room for 3 or 4 or 5, and that frankly, once we get to that point, that you're in a scale game, and that's it. That's the name of the game, and it finishes. Now, we could already be in that position in the UK. Lisa, do you think we're in that position in the UK? And how far do you think we are away in Australia? I think we've got 3, 4, 5 years, 2 years, 1 month?
I agree with the hypothesis. I think this is a scale game. I think you gain a lot in terms of the data learnings, and it means that once you get that data on the small businesses or the consumers that you lend to, you can then target more effectively, you spend less marketing dollars, and I think it perpetuates. So I agree with the hypothesis. I think the exception is actually where there are certain niches. So in certain niches, I believe that you can have more players, because actually you may have the player who is dominating in terms of a generalist approach, but actually there are some niches, and whether that is specific asset lending or whether that is specific property lending, where there will be more than one player.
David, do you think we're there? How long have we got in Australia before it gets to that position?
I mean, I think we're in, well, based on turnout today, or maybe hours, but all kidding aside, I think that we're probably 3 to 5 years away for consolidation. I totally agree with Lisa. I think it's more than, you can't talk about just general alternative lenders. There are niche lenders. There's small term, there's long term, there's invoice factoring, there's consumer. But I think in order of priority, obviously the US, the boat's left the dock. The UK, the boat's approaching the dock. And I don't think in Australia the boat's anywhere near the dock right now.
Jeff?
Yeah, I agreed and made that argument for many years, said at Lending Club in the U.S. and always used Amazon as an example. Obviously, there were just a terrific,
there will be one.
Yeah, I mean, it's a terrific number of e-commerce players for a very long period of time, focus on various niches and silos of merchandise or books or whatever it was, and clearly over time you found Jeff Bezos in a very dominant position. Not saying that's a perfect analogy, but it seems to me that again, aside from some niche-based businesses, or what I like to think of as essentially leveraging your IP and a focused on markets outside of Australia with IP that you've been able to develop and export the IP, you can still build incredibly nice businesses without necessarily reaching massive scale and being one of 3 or 4 dominant players. But
so any venture capitalists in the room, you've got 3 years, 3, 4 years?
It sounds about right.
Start now. Okay, thank you very much. Thank you very much, guys. Thank you, Ian. Okay, if we can ask our next panel to come up now, and we're going to look at the banks. We've left the best to last.